Hello and welcome to Get Set Taxes. The month of April heralds the coming of summer, the blooming of flowers, and the inevitable change into a new financial year. This can only mean one thing: taxes. In this video, we will tell you of the major changes that have taken place in GST, income tax, and personal finance since the 1st of April. Let's get started. There are a large number of changes that have been implemented regarding GST. Here are a few of them. If your aggregate turnover based on PAN exceeds Rs 50 crores in any financial year from 2017-18 onwards, you have to compulsorily generate e-invoices from now on. This means that every invoice issued by you will have to be digitally signed and will have a QR code and an invoice reference number that is generated by the GST portal. If your turnover is less than 5 crores, then you have to put a 4-digit HSN code in all B2B invoices. It is optional for B2C invoices. If the invoice is raised for an unregistered person, then you do not need to put any HSN code. If your turnover is more than 5 crores, then you have to put a 6-digit HSN code in all invoices, B2B as well as B2C. If there is a confiscation of your goods in conveyance and transit, then a penalty of 200% of tax payable will be imposed. This used to earlier be 100%. Further, the penalty will have to be paid in cash, and only then will the goods seized be released. There is no release on provisional basis as it used to be. The jurisdiction officer can suspend a GST registration if he finds significant anomalies between the values of your GSTR 3B turnover and GSTR 1 turnover as declared, and your input tax credit value versus GSTR 1 value filed by your suppliers. This just means that the filing of your returns has to be near perfect. Please be aware of the consequences of wrong filing. From this financial year onwards, you need to file your belated and revised returns before 31st December 2021. Earlier, the date was 31st March 2022. This comes with a maximum penalty of up to Rs 10,000. Dividend accrued from investments in companies will now come under the taxable bracket. Although this seems like an additional tax on the taxpayer, it really isn't. Earlier, companies would deduct tax and then transfer the dividend onto the shareholder. Now the liability is on the taxpayer. This also helps the government expand the tax net while keeping its revenues unchanged. Those senior citizens above 75 years and having an income source of only pension and interest will not have to file their IT returns anymore. Apart from these, there are a few changes in personal finance and trust registrations. From 1st April onwards, all trusts, societies, institutions, funds, and hospitals will have to obtain fresh registration. They will have to make an application in Form 10A with the Principal Commissioner on or before the 30th of June 2021. You can contact us to know the process of re-registering. The proposed interest rate cuts on small saving schemes of the government like the PPF, NSC, etc. have now been deferred. There is also a deferment in the new wage code. Therefore, there will be no change in your salary structure as of now. This is Get Set Taxes, bringing you up to terms with the new changes in tax compliance. Thank you for watching, and we will see you in the next video.